Hello, option strat traders. Steve Gans here. I've got kind of a unique opportunity to share something with you. If you haven't watched it yet, go back first and watch last week's Compare and Contrast series, where we put on a bear put spread and a bear call spread. Now, what I wanted to do was on these two different trades, both of these trades are nicely profitable at this point, up 158, up 148. So they're up about the same amount of money, which is what we expected when we did the series. That was kind of the whole point, was that these two were going to largely act the same. So let's look at the scenario that we put these on under. So about a week ago, we said that, the market is at an elevated level here. My expectation is that there might be a bit of a pullback. We just seemed to be overbought at the time. I mean, this was a massive, massive run. And this trade was done in the SPY, the S&P 500 ETF. So the expectation was that there might be a little bit of pullback, maybe down here to this 430 area or so would be a logical place for the market to pull back from a technical analysis standpoint. So anyhow, that was kind of the game plan, as we put on a trade that would benefit if the market stayed where it was or pulled back a little bit. So our market has in fact stayed the same and in fact pulled back a little bit, which is what brought some profitability into these trades. Again, this is up 154. This one is up 144. For all practical purposes, they're moving the same. So what might a person do in that scenario? Well, there's a couple different possibilities to consider. I'm going to enlarge each one of these. One thing is we could take a look at where this trade is at right now. Again, we can back this off and we can see where we're at, and we can say, you know what, if I am of an opinion that the market has done its pullback, and it might move back up from here, well, maybe I just want to close this trade out. Again, we're at a 31% profit. That's nothing to sneeze at in a few days' time. So that's one possibility, is you just say, you know what, market did what I thought it was going to do, take the money and run, move on, okay? Now, I'm going to show, and the same thing, of course, is true over here. So I'm going to show you another possibility to consider. Let's just say that the market has in fact pulled back. I don't think it's going to stay pulled back where it is. I think it might start to move higher, but maybe my opinion is it's not going to blast to new highs. But the key here is that I think it probably isn't going a whole lot lower. If I have that opinion, I can come in and I can add to this position. And I'm going to just turn these off. And I added these earlier. I'm just going to include them in the trade now. And now we've built this out into an iron condor. And if we look at our expiration line, we can see where before this thing, came all the way up into here, and we had a maximum of, well, I guess previously it was a maximum of about $400 in profit. Now we have a maximum of about $600 in profit if it fully decays under the tent. But we've also reduced some risk in the trade, okay? So where this used to have a risk that was, let's take this back off and let's take a look and see what that risk was. So we used to have a risk in this trade that was $539. By adding this, we have reduced that risk to around $390, something like that. So every trade, as we know, has risk in the trade. The thing with options is you get to decide, where do you want to have your risk? So if you feel that, the market's kind of done its pullback thing, I really don't think it's going to go much lower, well, you can add risk to the downside like we did here. And again, that will then reduce your overall upside risk in the trade. You did add downside risk as a trade-off for that, but you've also increased your theta. Theta had been $5-6 a day, or excuse me, $4-5 a day. Now it's $6.50 a day. So you're decaying a little more rapidly now. And again, you have done what's called flatten this T0 line. We flattened our delta a little bit from what it was previously. Again, let me just remove this real quickly so we can see. So with those two off of there, we're a negative 26 delta. That basically tells me that, this trade is going to do good if the market keeps going down. It's not going to do so good if the market continues up. For every point we go up, theoretically, we're going to lose about $26 in value in this trade. So again, if I bring these into play, I've cut my delta in half. So now an up move is not going to impact me nearly as much. Now, let's say I want to be flat delta. I want to be neutral delta. Well, I can widen out my downside risk a lot, and I can get this to where it's essentially delta neutral. In other words, in this particular case, the market has a pretty wide range. It can move in here and not really lose me money. But if it moves outside of this 430, I've got a lot of risk all of a sudden in this trade. I've got $3,000 plus in risk if the market were to tank. But I've dramatically increased my theta and I've made my delta flat, meaning that, I no longer have a bias one direction or the other for the market and for this position. Now, there's other ways I can do that too. I can tighten up my upside risk to flatten that delta. So right there, I can do something like that. Again, this is the great thing about a product like OptionStrat is I can play the what-if game all day long, and I can say, you know what, I think the market's going to remain kind of neutral where it's at here, and I can model exactly what I might want to do with this trade to represent my thesis of a neutral market, of not having much risk one direction or the other. So again, the takeaway here, what I wanted to show everyone was that right now, again, these should be paper trades, certainly, but right now you could consider either A, coming in and simply taking off that particular trade that you had on. In this case, it was the bear call spread, because it's up 30% or so, and just pull the plug on it and lock that money away. Or you could add a spread to the downside in this. You could basically come in, sell a call, buy a call, turning this into a call condor. And again, you're taking on downside risk to do this, but you're also flattening your delta and kind of putting that trade in a range that it could potentially decay in. And you've reduced your risk a little bit in that process. So again, the purpose behind this was to really show you that in either one of these trades, they are going to work virtually the same. Again, I can come over here and I can include selling a put here, buying my protection, and I end up with the same position here. I'm ending up in essentially, in this case, it's a put condor. In this case, it's a call condor. Really makes no difference in the overall scheme of things. They are going to react very, very similarly. So hopefully that gives you some good insight, again, into how you might consider squeezing a little more out of a trade that's going in your favor, or layering into a trade. These are the types of things that I like my students to learn is, start off with one thing with a certain premise, let it work in your favor a little bit, and then when it works in your favor a little bit, you can juice that trade a little bit by adding in other components to it. So that's it for today, everyone. Again, if you're a little unclear where we started, go back and look at last week's Compare and Contrast series, where we started off with just the two bearish positions that have worked in our favor up to this point, and then we added in a bullish component again, to juice our potential returns on this trade. So that's it. Thank you so much, and we'll see you next time.